welcome to Bell Direct's webinar, Managing Market Volatility in FY26. I'm Grady Wolf, Senior Market Analyst with Bell Direct, and I'm thrilled today to bring to you a panel of some of our leading research analysts to help you navigate what I'm sure you can understand is a highly volatile and quite a stressful time in the markets, because while valuations and while we're at record highs right now, there's a lot to navigate and a lot to understand and unpack. So we thought we'd do the hard yards for you and bring it to you in a webinar form today. Now, I do have to put a disclaimer on the screen. Anything we do say today is simply information only. If you do like any of the stocks that our panelists mention or any of the outlook or anything like that, please do your own research before investing, but let's dive straight in. For anyone who doesn't know Bell Direct, we're an online trading platform and we're here for all different investment journeys. We provide a platform for you to trade your investment securities and manage your investment journey. For new investors, it's for those building the foundations and understanding the market volatility and navigating your way through investing and starting your investment journey. We also have experienced investors and high net wealth investors as well. We have options for everyone. And we bring to you an exclusive Bell Potter research analyst and Bell Potter research arm to our division that a lot of other companies can't replicate. So that's why we're bringing the panel today. And so we'd love to have you on board as a Bell Direct client after today. And if that's of interest to you, we'd love to chat to you. It is free to sign up and you get all market commentary, insights, exclusive CEO interviews, and obviously Bell Potter research as well, which is a huge advantage to your investment journey. Now, I thought we'd start today by looking at and unpacking the factors that are impacting the market right now. And these constantly are changing, and that's why we like to set the ground rules before we dive into the panel. Factors impacting the market right now is what we're seeing is that there's a risk and growth appetite has regained momentum. So whilst over FY25, highly volatile times, we saw obviously lots of headwinds, so Trump, tariffs, geopolitical tensions. We had China's subdued demand and subdued economic recovery post-pandemic. There was a lot at play there. So investors naturally went into the safe haven assets of your banks, gold, the staple returns, stable companies as well. But now heading into FY26, we are seeing those headwinds ease a little bit. So we're seeing growth appetite and the growth appetite regain momentum, especially on the back of the AI revolution, which is driving valuations in the tech sector. And that's why I'm so excited to bring Chris Savage on a little bit later in the session to talk about that and obviously the tech sector as well. Now, inflation and rate cuts are still playing a part in markets at the moment and with the outlook for markets. We're seeing that whilst inflationary pressures are easing, GDP growth was most recently the data was out, was strong through Australia. Inflation remains sticky though, and we have the wages inflation as well. That's something to consider. Retail sales, we're still spending money despite lots of headwinds and high interest rates over the last financial year and high cost of living pressures, but Australians are apparently still spending quite a lot of money. So we'll talk to Rob Crookston shortly about his outlook on the inflation journey and the interest rates journey for Australia. And that will paint the picture for where he's seeing markets go on that front as well. Defense themes have really crept up the ranks in investment opportunities over the last financial year, and especially heading into the new financial year. That's why you would have heard companies like Drone Shield, Austal, and different companies like that we're seeing really have some tailwinds in the share price and momentum growth around the world, because investors are trying to jump on the exposure to different countries around the world renewing their defense spend. FY26 outlook, as I mentioned, we're seeing some tailwinds come into the growth of earnings as well. So while earnings were quite subdued through FY25 again because of the headwinds that I mentioned, FY26 we are seeing those pressures easing. So growth is back on the horizon for earnings. And again, I'll talk to the panelists about that very soon. And then again, investors are seeing opportunity in the small to mid cap space because valuations are soaring right now. So we're seeing opportunity for the small to mid cap space in the themes that are playing out in the market. Think about your data centers, AI revolution, green energy transitions, another one, defense themes and things like that. So we are also very proud to launch today our digital guide, which is the ebook that we've produced recently for you to help you navigate the markets as well. So what we've seen in the markets is it's a time to reset your investment goals and reset your mindset as an investor in this current market environment, because we are in a momentum market. And I know Chris Savage will explain that very shortly, what that means. But understanding differences between a trader and an investor is super important in this day and age. And that's why we say, think like a trader, because it's so fast paced and markets are moving every single day, but act like an investor. So remain on your constant journey, remember your investment goals, and understand that while a stock might move one day, understanding and keeping in your fundamentals of your investment journey is critical to ensuring the most success for your portfolio in this current market environment. So the key differences that we are seeing is the time horizon. So investors obviously think long and act long, but you need to be across constant market movements, because as we know, Trump can put something on Truth Social and that can move the markets overnight. So it's understanding that you shouldn't just hit the sell button because everyone's panic selling in the market. Sticking to the fundamentals, understanding that a company's growth is a long-term projection and trajectory is really important as well. We also see the speed. Obviously, you've got traders are very reactive. They look at charts, they look at price movements. They're not necessarily across the fundamentals. Whereas investors like yourselves are the ones who need to look at your Bell Potter researchers, keep on top of the different outlook that these analysts constantly spend so many hours looking at analyzing these companies, so you don't have to do it yourself. So that's where the Bell Potter research comes in very handy and is such an exclusive advantage for you as an investor in this market environment. So understanding the difference between traders and investors is a key fundamental of our digital guide that we're releasing today, and you'll all get a copy of as a thank you for joining the webinar today. And finally, so we've got our 4 rules of being investment ready. First of all, refining your strategy. It is so important to understand where your goals and objectives are in the market. You don't need to copy your friend. It's just understanding whether you have growth appetite, whether you have higher risk, whether you want income investing, the type of investment journey that we can help you with. And tools that Bell Direct has, like the strategy builder, is one that's really adaptive to your own objectives and goals. Then research and rule setting. Setting the rules on whether you want to buy in a certain price, whether you're going to follow the Bell Potter research, and understanding the research that goes behind this is so in depth, and it's taking the hard work out of investing for you. Then staying in the know, so up to date every day. We provide daily market commentary. I know Rob does his quarterly, monthly, and lots of different updates in the market. He's constantly keeping you across whether the macro or the global market environment as well as the Australian equity environment. And we've recently released the model portfolio as well, which really helps a lot of our investors on their investment journey. And finally, managing your direct investment funds. So ensuring you have the cash available in your Bell Direct account to jump on those opportunities as they arise as well. So there's the 4 rules to be investment ready. I think it's time to bring our panel in so we can start the questions. Throughout the session, we would love for it to be open for you as well. So we have Slido operational. If you have any questions for John, Rob, or Chris, please put them into Slido and we can get them to our panelists. But I have a set of questions that we can start with as well to get the ball rolling and obviously help you understand what's going on in this crazy market environment and have the best investment journey you can. So Chris Savage joins me today, head of Bell Potter Research. Chris has over 25 years experience as a research analyst and has covered various sectors, including technology, telecommunications, media, engineering, industrials, construction, mining, you name it, he's covered it. Chris is the head of research at Bell Potter, and we are really lucky to have him. He has extensive experience at Credit Suisse, Goldman Sachs, lots of different areas. So he really guides his team of over 20 analysts into the perfect market research and analysis environment. So Chris, I'm thrilled to have today with me to cover the tech sector and what he's seeing in the really high growth area of the market right now. Rob Crookston is the head of strategy at Bell Potter. Rob is an experienced research analyst with a demonstrated history of working across both macroeconomic and investment strategy. Skilled in equity strategy, asset allocation, financial and econometric modeling, data analytics, and turning insights into meaningful strategy. Rob joins us formerly from Wilson Asset Management, now on the Bell Potter family. And John Hester is a senior healthcare analyst. I thought we'd bring John in as well because healthcare there's so many catalysts in the space right now and it's a high growth area with so many readouts coming. And so I'm really excited for John to be joining us. He's a senior sell-side analyst with Bell Potter Securities in Sydney. He specialises in small and mid-cap healthcare stocks and has gained a lot of following over the years for his in-depth knowledge of not just one, but many different healthcare stocks with over 10 years experience in the industry. So gentlemen, thank you for joining me today.
Thank you, Greg.
Now, Rob, I thought I'd start with you. We are on the back of FY25 reporting season. What did you see? What were the highlights, lowlights, surprises, outlook for FY26?
I think the key word for the reporting season was volatility. And we've seen some volatility in the past few reporting seasons. This one's on a different level.
Yeah.
I think one of the key phrases that we've spoken about is don't miss. If you miss consensus expectations, you got punished. Disproportionately punished, probably, but you got punished pretty harshly. So, I take Woolworths versus Coles as a good example there. Woolworths, down over 10% on a sort of earnings miss. Coles up 10% on an earnings beat. And so, really, there you just got this disproportionate sort of reaction to what happens in terms of the earnings, in terms of the share price reaction. So that's one. The other sometimes was we had elevated valuations going into this reporting season, and just actually being in line with consensus wasn't enough. Take CBA as another example. Obviously, a very elevated valuation at the moment. Came in, it hit earnings expectations of consensus. It wasn't enough, and it was down 6% on the day. So you're getting it's very, very volatile at the moment, and it's very, very hard to read sometimes how the market's going to react to what we saw in reporting season. The other thing we saw is that US exposed stocks were punished and they struggled. We certainly saw that in the housing sector or housing exposed, something like James Hardie's, Reece, Reliance Worldwide. They all got, again, punished pretty severely. The market got very worried about their growth outlooks over the next 12 months after their results all missed. Yeah. And their outlook comments were pretty bearish as well. So there's the three key themes that I've taken out of that. Yeah. Looking forward to FY26, I think some of the key sectors I'll be looking at are the consumer. Yeah. Obviously, we've got rate cuts coming through for the domestic consumer. A lot's priced in, we've got elevated valuations, and obviously comes with that elevated expectations. So that the consumer needs to deliver for retailers. I think they will. I think we're really coming off a trough in earnings for the consumer. Valuations obviously moved ahead of the earnings. I think the earnings will catch up over the next 1 or 2 years, and we'll see that start to flow through, obviously off the back of rate cuts, more to follow, I think, in this year as well. So that's one of the key sectors. Probably the other one is also real estate. Yeah. I think we saw some evidence of the headwinds subsiding in real estate on valuations, again, supported by a rate cutting cycle from the RBA. That's now becoming a tailwind for valuations, and we're starting to see it actually flow through into a tailwind for earnings as well. Certainly the retail REITs, the housing exposed, they're turning pretty well and pretty quickly. So that's where we're actually exposed as well in our portfolio and where we want to be overweight at the moment.
Chris, technology sector for the season and the reporting season, what were your highlights, lowlights? And you did make some differences in valuations and you upgraded, downgraded. Talk to me about what you saw.
Okay, so like Rob said, it was a bit hit and miss. So I had good results like 360. I had less than good results like WiseTech. The sector, though, like Rob said, the valuations are already pretty stretched. So if you missed, you got punished. But as Rob also said, we're in an interest easing rate cycle now. So that's good for tech. That's good for healthcare. Mm-hmm. And so in theory, if you don't miss and you continue to perform, you'll be rewarded. And your earlier comment in a momentum market, mm-hmm. I think you got to be conscious what sort of market you're in. Yep. And we are in a momentum market. So the trend is your friend, as long as you don't slip up. So 360 might look very expensive, but they continue to produce good result after good result. And if you continue to do that, you should be rewarded. But what John and I do, I think, different to Rob, Rob's more top-down, yeah, which is why we got him. Yeah. John and I are more bottom-up. Yeah. We're looking for the good companies that perhaps aren't as stretched in terms of valuation and trying to find some gems or some diamonds in the rough. And there's some that I'll not talk about now because I know it's coming later, but there are still some opportunities that we can see.
Absolutely. John, what about yourself? Healthcare been a bit beaten down since COVID, but the outlook is there for growth in FY26. What did you see in reporting season? Obviously, it's a bit different on a reporting season front for healthcare companies.
Well, the most topical stock was clearly CSL.
Yeah.
There was an avalanche of bad news announcements on the results day, and of course the stock got punished.
Yeah.
We'll get into the detail in a little while, but certainly there's some major challenges for that organisation going forward. On the glass half full side of thing, the Pro Medicus result was outstanding. To Chris's point, the result was in line. It was a 30% EPS growth, and that's just continues a string of good results over the last 5 or 6 years for that group. So it remains this premium valuation for good reason, in my opinion.
Now, Rob, looking at the share market as a whole before we dive into each sector and stock specific, where is your outlook over the next 12 months? Investors have been kind of taking a sideline, thinking valuations are stretched, as I know where they are, but valuations are becoming less important as a metric right now, right?
I think valuations always have their place and you should always be wary of them.
Yeah.
But the environment we're in is also important and probably valuations have become a bit less important. I'm always still valuation aware. I think that is an important overlay. I think over the next 12 months for Aussie equities, I think I'm still constructive. So that means I think there's sort of an okay set of returns coming over the next 12 months. We've got a rate cutting cycle, which is important for the domestic economy, but also for sport equity valuations as well. I think we're also, at the moment, the Aussie market is seen as a safe haven. Obviously, there's a lot going on in the US, which we can talk about maybe in a bit.
Yeah.
I think we're reasonably insulated from that. You're looking at tariffs. For us, it really was a pretty immaterial impact to our economy. Probably the biggest one was beef exports. And what we've actually seen is beef exports volumes have actually increased since the tariffs have come on. So
which is crazy.
It really hasn't impacted us too much at all. So I think we're seen as a sort of safe haven in some ways, and I think there could be more money flowing over the next 12 months to Aussie equities as that volatility in the US continues in terms of policy. I also think we're seeing green shoots coming out of China as well, and certainly from stimulus. We saw the big dam project that was announced a few months ago. I think there'll be more of that more information flowing through on that over the next few months, on 12 months. And I think at some point they're going to have to go and look at property again and support that more and more. That should be good for our resources as well, resource companies. So I think there's a lot going on here that I think puts in good stead for Aussie equities. Obviously a few risks, as there always are. Valuations are elevated. What's going on in the US can flow through to us as well. But overall, I think I'm pretty constructive. Global growth should be okay. Our earnings should start to recover over the next 12 months. It's a pretty decent environment for our domestic equities.
It's exactly what investors want to hear. Now, Chris, you've made some recent adjustments to valuations of key names in the tech space. Technology One, I know, has been on your radar for a while, to a sell, back to a hold now. How has your valuation methodology had to adapt with the ever-changing environment and in the current market environment?
I'll tell you a quick story.
Yeah.
Right? When I joined Goldman's, the head of research said to me, Chris, how do you value your companies? And I said, DCF. And his response was, no, you don't. His response was, you got to do absolute, DCF, and you got to do relative.
Yeah.
PE, EV/EBITDA, EV/Rev, whatever it is. That was one of the best lessons I ever learned. You can't ignore what the market's doing.
Yeah.
So I suggest all the analysts do this, have a blend in my valuation or price target. It's a blend of DCF and it's a blend of relative. And by doing that, you're not ignoring what the market's doing. So I'll give you WiseTech as an example. I mean, that stock's been trading on 60, 70, 80 times PE for many years. If I stood there and said it should trade on 25 times and have a sell on it, I would have got it wrong for the last 5 years.
Yeah.
That doesn't help anyone.
Yeah.
I wouldn't have a job now. So as the market's gone up and the multiples have gone up, that comes through in your relative valuations and the price targets go up accordingly.
Yeah.
So sometimes it might look like we're just chasing the share price up and down. There is some truth to that to some extent, but that's just what the relative's doing. Now in Tech One, what I did there was, it was the story of buy, hold, sell.
Yeah.
I had a buy on it for, 10 years, a hold on it for a couple, I just went to a sell. Thankfully, I got the sell right, because it's always hard getting a sell right, particularly in a top 100 stock. But I went to a sell because it was trading at a premium to WiseTech.
Okay.
And I think WiseTech's a better business. So that was my rationale. It worked. I took the sell off as soon as it worked though, because like I said, it's not easy to get them right. So as you highlighted, I'm now a hold on Tech One and I'm still a buy on WiseTech.
John, how does the valuations play out for you as well? Obviously, changing metrics, changing valuations, it's a hard task to go from a buy to hold to a sell, back to a buy, back to a hold. How are you navigating the current market environment, especially with so much volatility, valuations, PME, as you mentioned, one to keep an eye on as well?
Yeah, well, there's two clear categories. Those stocks that are pre-revenue, like your Clarities and so on, are driven by results announcements in regard to their clinical programs. So that's a whole different valuation metric there. But we largely take a long-term view of revenue generation from those. So those absolutely geared towards a discounted cash flow type valuation.
Yeah.
As opposed to your stocks that are very high growth, your Pro Medicuses and so on. They are, as Chris just elaborated, driven by metrics, including the relative valuations, that Chris just went through. So, and then we come to stocks like Sigma Pharmaceuticals, obviously on a significant premium to others in the retail space as well. That has come onto the market, with the backdoor listing of Chemist Warehouse Group. So it's changed the whole dynamics for that group. It appears to be on a pretty solid growth path. It's going to be very interesting to see how that plays out over the next couple of years. But we're still very much, in healthcare, still very much focused on EPS growth that rarely lets you down as a guide to stock price performance.
Absolutely. Now, Rob, on a macro level, we did kind of briefly touch on Trump and the US and overnight, the US hitting record highs across the major averages, but no real reason why it should have done that with the jobs, payrolls, reassessment and reassessment downwards as well. So what do you think from a global perspective is the biggest macroeconomic risk that could impact not only the US markets, but Australian markets as well?
Yeah, it's obviously certainly what's going on in the White House. I'm probably near-term cautious US equities. I think, as you alluded to, inflation started to re-accelerate because of tariffs. I think we'll see worse data flow through over the next few months, which the market won't like. The market never likes inflation.
Yeah.
And at the same time, the labour market's starting to weaken. And it's weakened a lot quicker than I expected over the last few months. You're seeing jobs growth around about 20,000 people per month. The trend's about 150,000 per month. So it's a lot lower than trend. So I don't want to use the word, but I will, get that S word, which is stagflation. They've got that sort of mini stagflationary environment that I think will come through over the next few months. And I think the sticker shock of high inflation and a labour market that's deteriorating pretty quickly could worry the market, and we could see a sell-off. So I think there's a bit of a perfect storm brewing, maybe potentially in the US and US equities on that. And that could be a key catalyst for a market sell-off. And that's the key risk. And unfortunately for us, we're heavily correlated. For Aussie equities, we're heavily correlated to US equities. US equities, US bond market, they calibrate pretty much every single developed market in the world. So, if they catch a cold, if they sneeze, we catch a cold, that could flow through. So I'm still constructive on a 12-month view, but I'm just very wary that over the next few months, there could be just that sort of very bad data that comes through and we catch that cold.
Near-term volatility. Hopefully
right.
we don't get colds around here. Chris, you are bullish on WiseTech. We kind of touched on this one, but why do you still have a buy rating and your price target?
Sure.
Or you can explain your price target.
So the one disappointment for me in reporting season was WiseTech. I pushed it as a key buy of mine going in and it didn't quite turn out, unfortunately. And the reason for that was they missed slightly on the result and the guidance wasn't as strong as the market anticipated or wanted. So the reason why I'm still positive on it is I still think it's a great story and I still think it's a buy on a 6-12-month basis, and our recommendations are basically based on a 12-month outlook. The issues I obviously won't go into now around the result or the guidance. I think they're explainable. Yeah. But as I remember saying on the day of the result, when you're having to try and explain it, you've already lost the battle.
Yeah.
I do think, though, that it'll come through. I think WiseTech's probably the best tech company I cover.
Yeah.
was going to say the best tech stock on the market, but I don't cover Pro Medicus. John does, and that might be as good, if not better. But it's the one truly global software company we have, which is the market leader. And believe it or not, their key competition is the customer. They're not displacing a competitor. They're more often than not displacing the customer's systems. Wow. So there's a huge domino effect once you start doing that. And we're basically talking global domination. Like, there's not many Australian companies you can say are in that position. There's obviously been a few speed bumps, like I alluded to, including the CEO or founder's own behaviour. I think that's going to start to fade into the background now, and the fundamentals will start to shine again. And I think on a 1, 2, 3 year time frame, WiseTech's still very good.
Absolutely. So trading at a discount now, still buy?
Yes.
Beautiful. Now, some key readouts, John, are due this year, and I know healthcare as a whole really relies on these readouts for share price reactions. Can you explain which ones you're keeping your eye on at the moment and which ones are exciting over the next financial year?
Sure. So the radiopharmaceutical space has been really interesting for 2 or 3 years now. The two dominant companies in the space in Australia are Telix Pharmaceuticals and Clarity Pharmaceuticals. So I'll deal with Clarity first. So they've got some pretty exciting data coming out over the next 4 to 6 weeks, and that is their co-PSMA trial. This is a head-to-head study of their copper-64 diagnostic relative to gallium. And gallium, of course, is an isotope which is used by Telix with their very successful drug Illuccix. Both do the same thing, that is trying to identify prostate cancer. So co-PSMA is out in a few weeks' time. It's a trial that's been conducted just up the road here at St Vincent's. It is a head-to-head study in 50 men with known prostate cancer, and it's all about detecting which asset detects the very small tumours. And if you can detect those tumours small, when they're very small, you're more able to do something about it. So potentially changing the treatment paradigm. So that's going to be really exciting for them. Also for Clarity, later in the year, November, December time, we're expecting readouts from their Secure trial, which is their exciting therapeutic trial in men with late-stage metastatic disease. So that, more than anything else, is probably that carries the highest amount of value for Clarity. So we're going to be really interested to see what happens there. The key data there that we're looking for is the PSA 50 rate, so the number of men on the trial who have reductions in PSA levels below of greater than 50%, and also progression-free survival. So really exciting for them. Elsewhere, Telix has also got some data from their prostate global trial coming out for the end of the calendar year as well. That's also a therapeutic trial, so pretty exciting there. So plenty of news flow to come from both those stocks.
Now, I can see on Slido there is a question already about Telix, and what are your thoughts on the company considering the FDA challenges they're facing? Are these good long-term investments in your opinion?
Yeah, so just to refresh everyone as to what's happened there. So Telix has had 2 complete response letters this year. The first was in relation to Pixclara, which is their brain cancer imaging drug. The second is in relation to Zircaix, which is their renal cancer imaging drug. Both were expected to sort of not sail through, but there's always risk attached to FDA reviews. But the good news is that they're not therapeutics. They are drugs that are used exclusively in markets outside of the United States. So the FDA has gone back to them and asked them to resubmit both applications, which the company intends to do in a relatively short time frame. We heard from Telix yesterday about the time frame for the resubmission of the Pixclara asset, and that will be done within the next quarter. So my feeling is that it's a question of when, not if, these drugs get approved. The FDA is unpredictable, and it's hard to say with any great certainty around whether they'll approve the resubmissions. But I do feel that eventually these will both get there. So yes, the answer to the question is I'm very confident about the long-term prospects for Telix. I've got on a buy with a price target of $23, well ahead of where the stock is currently trading.
Absolutely. Now, Rob, given your view on the world right now, what is your preferred asset class?
I'll stick to equities, but it'll be global. It'll be sort of quality equities. What do I mean by quality equities? Well, there's sort of resilient revenue growth, strong balance sheets, highly profitable, Normally good management teams helps as well. Quality should provide some downside protection if we do see a sell-off. They are normally seen as safe haven equities, so people flow to them when the market sells off. But you also should get the upside capture as well if the market keeps grinding higher. They are normally great stocks, highly profitable. They reinvest that cash they generate back into the business, and that normally generates the earnings growth that you see from them. So they're normally seen as stocks that grind higher. I think we could be in a grind higher environment if there isn't a sell-off over the next sort of 6 months. So quality for me is where to be in terms of factors.
Now I will jump to one of the questions on Slido as well. There's a lot of commentary. The last one there. Plenty of talk about significant downturn looming. How would you, because I know you've just brought out the model portfolio, how are you positioning for that potential downturn that we are seeing?
I think in equities itself, what we're doing, so obviously quality is one. The biggest overweight at the moment is real assets. So it's sort of real estate and infrastructure. They're obviously pretty defensive in terms of their cash flows, but they also should benefit from the rate cutting cycle as well in terms of their valuations and the debt that they hold as well. So we like them. We think they give the best of both worlds, that they should be pretty defensive if we do see a downturn, but they also should actually perform pretty well in an environment we've got rate cuts, which we should do at home and in the US as well. So that's what I'd like in terms of in the actual equity portfolio or the equity portfolio. I think outside of that, we look to bonds as well. I think bonds are pretty interesting. First time in a long time that a 10-year government bond yield gives you a higher yield than the Aussie dividend yield, the market dividend yield. So I think that's pretty interesting. And I think, as I said, if you see a sell-off, bonds perform very well in that sort of environment relative to equities. But I still think they'll give you very reasonable yields at the moment. And should tick along pretty well over the next 12 months.
Now, you did mention dividends there. I will jump on that because I know in reporting season, a lot of companies that either cut dividends or added a special dividend were punished or rewarded, respectively, by shareholders. Where do you see dividends going over the next year? Because they have come down a bit.
I think they should flow with earnings growth. So everyone's expecting an earnings recovery over the next 12 months. And really, dividends should support dividend growth as well. Probably, actually, a lot of companies have been paying more than relative to their earnings over the last 12 months because earning growth has been so weak. But I do expect to see dividend growth over the next 12, 24 months as the earnings growth comes through as well. So I think the outlook's getting better. So I expect dividend yields to improve, but probably not get back to the levels that we saw a few years ago in terms of the yield because the valuations are so high. So it's more of a price aspect at the moment rather than the actual dividend itself.
Yeah, and M&A activity, thoughts on that across each of you?
We've seen some action already, certainly in resources. I think the problem is at the moment that valuations are very stretched.
Yeah.
So when in that sort of environment, there aren't great opportunities that are out there. Yeah, that's right. So I think there's still some value out there and some PE firms might look to go and buy those in the next 12 months. But I think at the moment, we'll probably see a bit less activity in the sort of broader industrials at the moment because valuations are so high.
Now, Chris, high growth tech sector, tailwinds coming, interest rate cuts. Where is the biggest growth in the tech sector, in your opinion, where valuations aren't quite stretched out?
Okay, so I think higher growth always tends to be with the smaller companies because obviously the hurdles are lower.
Yeah.
With that said, WiseTech is still growing very strongly, as is 360 and Tech One. But the sweet spot for me, but I think for Bell Potter in general, is we like to find those high growth stocks at the small mid-cap space. And I think I've found two that really stood out for me in the last few months. And it's a bit rare because I haven't found two stocks I think this good for some time. And they both delivered good results in the months just gone. So the two are Adveritas and Canadico.
What are their tickers?
AV1 for Adveritas and KYP for Canadico. As you know, Grady, we did a Bell Direct event several weeks ago and I went through Canadico. If there's time today, I'll go through Canadico, but I thought today I'd just go through Adveritas quickly in a couple of minutes. So I think the best way to sort of explain this one and the potential upside is to explain what they do.
Yeah.
So it's a global software company that's a leader in its key market. So that ticks a lot of boxes to begin with. You know, you think of WiseTech, you think of Pro Medicus in that sort of group. But this is very much at the small end. So what they do is ad fraud software, and they do it for principally sports betting companies today.
So a very niche part of the market.
Very niche part of the market at this stage. So they are global. So their customers are Bet365, Ladbrokes, Entain, Sportsbet, Betr, William Hill, all the big names, DraftKings as well in the US. So they are the leader in what they do with those companies. So what their product is, it's called Traffic Guard, and it's basically set up for Google, which, as you know, is the principal advertising digital platform in the world today. What they're now doing is they're developing more versions of Traffic Guard for Meta, which has become the second leading advertising platform, digital platform, and then also for what's called affiliate, and that's basically any platform outside of those two. So they've got customers using Traffic Guard for Google. They're now going back to those customers and they're saying, do you want it for Meta and do you want it for affiliate? And the customers are basically falling over themselves to get it.
Wow.
So it's going to be a very easy, I think, cross-sell for the company, and it will basically double the ARPU more or less for those customers. So if a company's paying $100,000 today for Traffic Guard for Google, they're going to be probably paying about $200,000 for Traffic Guard for Google, Meta and affiliate.
They have the existing client base already.
They have the existing client base already. So it's just a cross-sell. They don't have to go and win the customer, and they're basically rolling that out now.
Yeah.
So we're going to see a little bit of it in the September quarter. We're going to see a lot of it in the December quarter.
Yeah.
So I think the next result 6 months away in Feb is going to be a lot of growth, put it that way.
Yeah, so for these two companies, you've kind of found them in the smaller space. What attracted you to them?
I think it's the Bell Potter model, right? It's not just the analysts looking at it, it's also corporate, it's also the desk.
Yeah.
I'm happy to say that it was corporate that found that one, and there's nothing wrong with that.
Yeah.
They just suggest, for instance, that I see this company, I go see the company, I form my own view. My view was, wow, this thing is good. And look, that's also the Bell Potter model. I mean, at Veritas, we've already done a raise for, so corporate wins.
Yeah.
The share price has already doubled since I initiated on it. So if you followed me from the start, you would have doubled your money. So our clients would have made money.
Yeah.
So that's the model. You know, it's been a win-win so far. But while it's already doubled, I think it can still double or triple again from here.
And that really is the philosophy of Bell Potter and Bell Financial Group. We've got everything covered. Even for our retail investors, you get access to the reports that all of our analysts provide. So that's really important to understand. We have an umbrella company across all of our divisions, and that's why we love to help every investor in the market. John, there's a lot coming through about Mesoblast.
Yep.
That was my next question for you. It's been on a tear. We recently sat down and spoke to Sylvie, the CEO. Where does it go from here?
Yeah, so just to bring everyone up to speed, Ryoncil was approved by the FDA last December, and it was commenced marketing on the 28th of March, and for the June quarter it generated around 11.5 million in revenue. So this drug is a revolutionary drug. It's the first ever stem cell therapy approved for the treatment of graft versus host disease. In fact, the first ever FDA approved stem cell therapy in any capacity. So it is indeed in rare air, particularly for an Australian company. So over the next couple of quarters, it's going to be really important to see that revenue line grow. In fact, I think it'll probably take more like 12 months, 4 quarters of good growth for the company to dispel any fears the market may have that it is a pretender in the space. There's nothing like good revenue growth to give people assurance that actually the company is for real and the product is for real and that physicians will adopt it. So those are a couple of things that I'm looking for. So it's that revenue growth on the longer term basis, which I think will drive the valuation. Very similar to what we saw with Telix. It took them 6 quarters to dispel the notion of being an R&D company into being a full commercial offering. So Ryoncil is going very well. We're expecting between $15 to $20 million of revenue for the product in the September quarter, and ongoing growth from there. And sort of for FY26, we're looking at revenues of US $70 million. I think if they hit that number, then that notion of it being an R&D company will be forever dispelled, and we'll be looking at ongoing growth from there. That 70 million though is not that far away. Given if you annualise that first quarter number of 11, push it to 44, you don't need that much growth to get to that revenue number of 70. It's $1.5 million per patient that they get for this drug on average.
Yeah.
There's only 3, it's a micro indication, graft versus host in pediatrics in the US. It's only about 300 patients a year. So it's a very concentrated market. So the selling costs aren't much. So that revenue growth will very quickly transition into cash flow positive earnings, we feel.
Yeah, absolutely. Now, CSL is another one we need to talk about. It's come under a lot of pressure. You did briefly mention it earlier in the reporting season outcome. One of our viewers is asking, what are your short and long-term expectations for CSL, and how do you see the company faring now?
Yeah, well, Paul McNamee, the chairman, has recently come out to the market and indicated it's time for a reset.
Yeah.
All 3 divisions are facing headwinds. Behring, which is the jewel in the crown, had lost a couple of contracts. And they've also indicated that it's not going to recoup its gross margin performance in the short term, at least. Vifor, they've arguably overpaid for $19 billion a few years ago, and its performance has been underwhelming. And then there's Seqirus, which is the vaccines business, and there's all sorts of issues, headwinds in the US for the vaccines business as well. So they've decided to divest that. So it is, and I think the other piece there is that the performance of the R&D piece has been underwhelming, to say the least. They had the major fail going back a couple of years ago for CSL 112, which was their heart failure drug.
Yeah.
And really the company's been reeling since then. They had the first strike on the REM report at last year's AGM. So I think that really conveyed the message to McNamee and the rest of his board that it was time for a reset. So they have slashed their workforce. 10% of them are going. They've sold Vifor, and really I think everything is up for reevaluation at the moment. So it's fair to say I think the stock is in the doghouse for the moment. It's going to take a year or 2 for them to come up with a strategy to reclaim the glory days of the going back to a couple of years ago is probably when that finished, but they were doing strong double-digit earnings growth every year. That's what they're aiming to get back to. I think they need to do more M&A, closer to home, closer to their blood products business. So, look, that's going to take them a while to work through. Still a good company, but absolutely no need to sort of rush back into the stock at the moment. And we've got it on a hold at the moment. So
absolutely. Now, Rob, where are you currently finding the most compelling opportunities? Again, there's valuations are stretched, markets record high. Investors are looking for those hidden gems. So where are you seeing the best opportunities right now, and from large to small cap?
Yeah, definitely. I think we're going down the scale in terms of size at the moment and looking at those mids and smalls. I think you're finding at the moment that you've got better valuations for better growth stories. If you look at the large caps, look at something like CBA, it's on extortionate multiple, 26 times PE. It's got effectively flat growth over the next couple of years. And you compare that to some of the smalls and mids where you can get them for a lot lower multiple than that, and they'll have 10, 15, 20% earnings growth to come through over the next few years. So I'm finding that you're getting better growth stories at a better valuation. I think also for smalls, they're more Aussie-centric, they're more domestic focused. Obviously, a lot of large caps become global stocks, and that's sometimes a good thing. But I think at the moment, being Aussie-focused is a good thing for what's going on in the rest of the world. Obviously, you've got the RBA cutting cycle coming on at the moment. So I think the domestic economy should recover, and that should flow through to a better environment for small caps as well. So I think it's looking pretty good. I still think they're under-owned. And I think what's interesting in the reporting season is large caps struggled, small caps did really well.
Yeah.
And I think maybe actually the market realised that the small caps are with some good stories here. Valuations weren't elevated, so there wasn't so much of a sort of overreaction to some of the stocks. And I think we've seen a shift slowly over the last few months into smalls. We're currently overweight in our portfolio, small caps, with the views that just was spoken about.
Yeah, talking about asset allocation and portfolio allocation, where are you finding the greatest allocation right now, and are you comfortable sitting with that for the short to medium term?
I think where I'm probably most underweight at the moment is US equities, is global equities. Only by a bit, but I think that's sort of where my most negative tilt is at the moment. Sort of neutral to overweight Aussie equities. I sort of spoke about, I'm overweight bonds.
Yeah.
As I said, I think they give you good defensive exposure at the moment, which I think you might need in the next few months. Very good yields relative to the earnings yield or the dividend yield that stocks will give you. And probably the other thing as well I like is gold.
Okay.
And I've liked gold over the last 12 months. It has performed well. It has rallied hard. I think as we go into a potential stagflationary environment, gold should perform well in that environment. And just the uncertainty that we've got with Trump and what's going on with policy around the world, potential for further wars as well, gold should hold up pretty well.
Yeah.
So I think it's important to have some allocation to gold in an asset allocation.
Now, I might jump to, I know resources aren't we don't have a resources analyst, sorry, we'll get them on next time. But Rob, you might be able to answer these. There's a bit of resources, the sector cycle at the moment, and lithium as well. What's your view on lithium and the outlook for that? I know you're bullish on copper. We can touch on that too.
I think on resources, yeah, as I said, I think we're seeing green shoots come out of China at the moment, and that should flow through to a more bullish outlook for resources that have been really under pressure for the last few years. Yeah. Especially since Russia-Ukraine, really. It's just been a downfall since then. I think their valuations look pretty good. I think the risk-reward is looking pretty good in terms of value at the moment. And I think if you start to see, as I said, more information, good information coming out of China on infrastructure builds and on property stimulus, that should support commodity prices higher, and that should obviously flow through to our resource earnings as well and our resource stock. So I think overall we like them.
Yeah.
Probably just a bit wary of iron ore in terms of probably structurally challenged over a long-term view. Probably Chinese property, while it could get propped up in the near term, I think it probably has run its course, and that's been a big tailwind for iron ore in terms of demand over the last 10, 20 years or longer. So just wary there on iron ore. But I think certainly things like copper to me look good. What I like about copper is it should be supported by a general global growth recovery, which might happen in the next couple of years. But it's also the transition, the energy transition, where it should be supported. An EV car, for example, uses 3 times more copper than a traditional ICE vehicle. And the same for renewables as well. They use a lot more copper than your traditional gas or coal power plants. So I think there'll be a lot more copper needed in the future. And what we're seeing on the supply side is that it's really hard to get new supply at good grades. So grades are going down, and that means really that costs are going up.
Yeah.
So if the cost goes up, the incentive to actually build a new mine goes up,
Yeah.
and you need price to only go one way, and that's up.
Yeah.
So I think copper prices can continue to run from here. They've run pretty well over the last year or so, but I think they can. This is a 5-10 year super cycle story for me on copper. On lithium, it's a harder one.
Yeah.
I think what we've seen is an absolute bull market, obviously, a few years ago. Prices ran very hard, and we saw a lot of supply come online because of where prices went to in that mini cycle. So I think at the moment the demand supply is just imbalanced. There's probably a bit too much supply for the demand, and that's why we've seen prices where they are. I think it would take a couple more years to get demand and supply to be in a better position in terms of the balance. So I think there's a good long-term story there for lithium, but I just think in the near term, on the 1 or 2 year view, I'm just a bit cautious that probably prices just are too low for a lot of these producers at the moment.
Yeah. Now, I'm not sure if you can answer this one. This one might be better for a conference in resources like next week, Resources Rising Stars. But with the forced closure of coal-fired powered stations and their replacement with renewables, how do you see this impacting the market? Is that something you can delve into?
I think what's interesting is, that's happening in developed markets. Potentially could happen here as well.
Yeah.
But I think what we're still seeing is that demand for coal globally in developing markets is still increasing.
Yeah.
That's obviously getting partly offset by the developed world. So the demand is really flat. I think potentially a lot of forecasts out there for thermal coal we're talking about there with power plants are probably too bearish on the outlook.
Yeah.
And I think emerging markets will need coal power for low energy costs over the next 10 years, and coal will still be in pretty high demand over that period. So I think that at the moment the market, it certainly was a few years ago, it's probably recalibrated a bit over the last few years, but I think the demand story is still there, and coal prices can still stay up probably where they are at the moment in terms of thermal coal prices. That's good for your Whitehavens and your New Hopes. I mean, what Whitehaven's done really well, it's one of the biggest now coal producers, listed coal producers on the ASX. It's moved to met coal.
Yes.
Met coal's used in steel production.
Yeah.
I don't think that's going anywhere for the next 20 years. So really now Whitehaven is 50-50 thermal coal and met coal, actually, and it's increasing its met coal exposure. So I think really met coal is still in a pretty good position. That demand isn't going anywhere either. And we're finding that supply is getting harder and harder to bring online for ESG reasons.
Yeah.
So again, that imbalance should be supportive of met coal prices over the next 5 to 10 years.
And diversified earnings obviously playing into the China rebound, so that naturally bodes well for a met coal company like Whitehaven Coal. Chris, AI, can't let you go without the AI question. A lot of investors think they've missed the boat, NVIDIA, all these companies. How do you best see an investor getting exposure to AI for those who think they've missed the boat?
Sure. I think the way to look at AI is, I mean, it's hard to find an AI stock.
Yeah.
I mean, is NVIDIA an AI stock? I don't know. It's obviously driven by increasing demand for AI computing, but is it? I don't know if it's an AI stock. In Australia, do we have an AI stock? Maybe Decider.
Yeah.
I don't cover it. It's ripped.
Yeah.
So I'm not going to comment because I don't cover it.
Yeah.
I think the way to look at it is what companies can benefit from AI. So, and I think the companies that can are very much more towards the larger end because they can drive the efficiencies. So we're seeing Telstra do it. Their next 5-year strategy is basically based around AI and the efficiencies it can gain. The banks are doing it. I won't comment on ANZ's job cuts yesterday because they said it wasn't AI, but yeah, I don't know. So when I look at my stocks, again, it's towards the larger end, and the two I'll quickly quote are Tech One and WiseTech. So WiseTech generates about a 50% EBITDA margin, and they're starting to hit the ceiling in terms of that margin. When they introduce AI, well, AI is already evident in their business, but the more they introduce AI, I think that EBITDA margin can go to 60 or 70%.
Yeah.
So it's a margin increase story. Tech One's the same. They've got a PBT margin target of 35% in the next 5 years. That I think is going to move more towards 45% as they introduce more AI into their business. So that's how I would play it. Pick the stocks that can most benefit from AI. It's not going to be at Veritas. They're not big enough yet to get huge advantages from AI. It's going to be at the big end of town, particularly those that use a lot of, for tech coders, particularly offshore coders, that can be replaced with AI.
Which is crazy.
That's obviously a slightly sensitive subject, so I don't want to sort of overplay that one too much.
Yeah.
But the banks are the same, obviously. There's lots of that sort of semi-white collar type worker that can be replaced by AI.
Yeah.
We'll see what happens.
We'll see it play out over the coming years. Now, John, can't let you go without talking about 40X. Naturally, 40% share price rise in one day. That is simply incredible. What's driving it? Where does it go from here? What's your outlook?
Yeah, so 40X had a great run earlier this week. So what drove that was the announcement that the FDA had approved a highly technical product called a CT-VQ. Now, a VQ scan stands for ventilation and perfusion. Okay, so ventilation, relatively straightforward. You know, you're looking at the lung structure of how a person's or a patient's lungs are functioning. Perfusion, though, is the analysis of blood flow in the lungs. So getting into some technical ground here, but you know, the traditional method of doing a perfusion scan was to use an iodine contrast. You put iodine into the patient's arteries and then you stick them under a PET scanner and you look for where the blood is flowing in the lungs, and you cross-match it with the ventilation scan and you come up with an analysis of, you know, essentially whether that patient has got a pulmonary embolism, a blood clot in the lungs.
Yeah.
So what 40X have done has come up with a contrast, a method of doing that perfusion piece without the contrast. And that got the market very excited because the FDA approved that, and the company also announced reimbursement via a Category 3 code in the US. So very exciting for them, and the market sort of took that news and just started buying it. A lot of that was retail buying though. And we've sort of seen some volatility though, of course, in the last couple of days as well. But nevertheless, it is a major reset for the company. I was just talking to Andreas Fouris, the CEO and tech director, earlier this morning, and he remains very excited, and they've got plenty of interest from academic institutions in the US looking to adopt that. And we've got an interview on Friday, actually, this week with one of the physicians out of University of Chicago talking about this technology and how it's going to impact his practice. So very exciting times for them.
Beautiful. Now, a minute each to do a buy, hold and sell for your sector or the market right now. As in buy, hold, sell within a minute. Let's go, John.
So stocks that have come back a long way. Telix looks pretty interesting at this stage. It's come back from $30 to $14. As I said earlier, I think that they'll get both those approvals for Pixclara and Zircaix. So that's a buy for me.
Yep. A hold?
Look, I think that at the moment, CSL is no worse than a hold. Yes, they've got some reset to do, but it's still a high-quality company, a very high-quality management team. You know, I'd be pretty confident that they can pull it back from here.
Yeah.
So, I think that of all the large caps, that probably looks the deepest value in my opinion.
Yep, and a sell?
Well, we've got Nanosonics on the sell at the moment, and it's been a good call. It's about a $1.4 billion company. They've had some headwinds in relation to the rollout of their new product which is for the reprocessing of endoscopes.
Yeah.
It's been delayed several times. It's unlikely to generate meaningful revenues in the next 1 to 2 years, I think. So it is a clear sell for me.
Rob, buy, hold, sell quickly.
We'll go sell on CBA.
Yep.
As I said before, elevated valuations, no growth. You look at it versus global peers, it looks extremely expensive.
Yep.
So sell CBA. Hold, I guess something like JB Hi-Fi.
Yep.
I said I think the consumer will do well over the next 12 months, 24 months, and I think the retailers obviously will do well from that too. But again, on a very elevated valuation, a lot is priced in there.
Yeah.
I think one slip up and it could be a sell-off. So just wary of that at the moment.
Yep.
Buy, I'll go for something like Goodman Group.
Cool.
It's a leader in industrial property, but over the last couple of years, it's shifted to data centres. Now 50% of its work in progress is data centres. They have a high development margin. And obviously, it's a long runway for growth on data centres, I think, over the next 10 years. Founder-led business. It's truly global. The balance sheet set for the build over the next sort of 5 years. And what I like really is the biggest customer in its just logistics business is Amazon.
Yeah.
And one of its biggest customers in the data center business is going to be Amazon.
There you go.
So it's already got that customer synergies already. I think it's set for a good decade.
Chris, buy, hold, sell.
So the buy in small cap is Veritas,
Yep.
which I went through. The buy in large cap is WiseTech,
Yep.
which I guess I also went through. The hold is Telstra.
Yep.
I like quoting Charlie Aitken on this one. If you can't find anything better than Telstra, you're not looking very hard. It's fully valued. My sell, like I said, I upgraded Tech One to a hold just last week.
Yep.
It's still probably my sell in the sector, but it's really on valuation. I'm always nervous about putting a sell just on something based on valuation.
Yeah.
I'm always a believer there's got to be a catalyst, a negative catalyst in this case. Tech One I don't think is going to trip up.
Yep.
They're very good at just delivering year after year, and I think they'll continue to do that. But while it's trading at a premium to WiseTech, I just think it's probably the sell in my space.
Well, that wraps our webinar for today. And thank you so much to the panel, Chris Savage, Rob Crookston and John Hester for joining me. We're going to aim to run these a little bit more often because we love to present to you exactly what our house is working on, the house view, as well as helping you navigate the ever-changing market conditions that we're finding in FY26. Now, what's next? I'll get the slide up now. First of all, the digital guide will be available after this recording and after this webinar. So you have, I think it's about a 58-page of reading. So your next train ride, road trip, plane flight, we're here to help you. And we took a long time, blood, sweat and tears to write that for you to help you understand where you're placed in the market right now and really identify the opportunities in the market. Next up, cash account. Ensure your cash account is topped up so you can never miss an opportunity like the ones that our analysts present to you today and every day through their research. research. And finally, stay in the know by following our Bell Direct social media platforms and signing up to become a Bell Direct client. We'd love to have you as part of the family. Thank you so much for joining us today, and we look forward to joining you for you to join us at the next webinar that we host.